This is the Traders Exclusive Live Trader Showcase. I'm Sherry. This is the quarterly event where we feature expert traders and bring you training and insights from 20 expert traders. We have prize giveaways for everyone in attendance. We're going to do some drawings. We have some surprise interviews. Please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. This is also where you're going to find the recordings for this event. And before we get started, we have to share a quick disclaimer. You know it. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not necessarily indicative of future results. This is training. You have to do your own research, and you should always verify and research. Well, we're about 3 minutes early, but I wanted to say hi to Adrian and Julie. I want to thank you guys for joining us for today. And I wondered if I could ask you a quick question.
Sure.
How did you get started in trading?
Well, that's an interesting story. So we were, and I've got to tell you, I've got to give you a little disclosure here. Julie is off at the emergency room with the dog. The dog is off, so I'm going to do this one solo today.
Oh, I'm sorry to hear that.
Who's in the hospital? Yeah, we're hoping he's got an infection, and we're hoping he's going to be okay. But the show must go on.
Yes.
So I'll tell you, we started trading in graduate school. So we were working on our PhDs, MBA, PhD out at the Claremont Graduate University. And, graduate students need data, and you're always looking to crunch data. And there was no data that was better than the stuff that you could get about stock trading, right? So you could get every tick from every exchange on earth. So we just started putting together these models while we were in school. And, I had a very interesting guy. I had Peter Drucker was on my dissertation committee. If you guys are in your 50s or 60s or older, then you remember Peter Drucker. He was just a huge business guru. And, we took those numbers that we had been working with, and we started trading our own account. We got married, we got married kind of late. We were 30 when we got married. And then when I went to defend my dissertation, Drucker says to me when I'm done, he says, well, doctor, what are you going to do now? And I said, well, I think, I'm probably going to work for, McKinsey and Company has been recruiting us pretty heavily. And, it looks like we're probably going to go the consulting route. And his advice to us was, he said, well, didn't you start a profitable business while you were here in school? And we said, yeah. And he says, take it from, he says, so you want to be a business consultant? Take it from the best business consultant in the world. He was a little full of himself, but he was fantastic. He says, if you've got a profitable business, stick with that business. So much to our parents' horror, we graduated with all these, with this alphabet soup after our name, and we've never actually held a job. So we just traded our own account since then. We worked pretty heavily with the New York Stock Exchange, getting down on the floor, working with specialists. We both have PhDs in psychology, organizational psychology. So it was neat to go in and, be able to work in this like specialist system where it was always, one guy on the other side of the trade, and you could sort of learn the personality of the stocks and everything. So it fascinated us. We stuck with it obviously for 25 years now. And, we just love it. I mean, we do some education stuff as well, but, our primary business is and always was trading. So there you go.
I love it. Never had a real job. That's a hoot. That's a hoot.
It is a hoot, right? Unless you paid $400,000 for an education that, well, I'm going to say we used it, right? We used it. We just used it differently than we thought we would.
Yeah. All right. I'm going to mute you for just a second because I'm getting some
Sure.
echo and introduce you, and then you can take it away. There we go. Okay. All right, guys. Dr. Adrian Manz is in the house. I'm kind of sad that Julie's not with him. I was really looking forward to it for Women's History Month, but us girls got to take care of our puppies. Okay. And he's going to be talking about, and maybe he'll be changing the topic, but what I have is volatility edge, psychological tactics for market profits, which is I'm in the time that I've been doing this for Traders Exclusive with no background in trading whatsoever, I feel like the psychology is the biggest factor. So they're going to bring you some really good information. Their website is traderinsight.com. And I'll just give you a little rundown real quick that, let's see, Dr. Adrian Manz has been a successful professional equities trader and earned his living trading his own account for over 2 decades. He provides education to serious traders who are looking to add new interpretations of the markets to their repertoire. Dr. Manz has developed a trading style that relies on statistical, technical, and fundamental analysis in the planning of every trade and has found methods to extract the most out of every setup every day. He is the author of 2 books on the subject, many articles featured in leading industry publications, including Stocks and Commodities, Stocks Future Options, Active Trader, Traders, and Moneymaker, as well as the publisher of the Daily Income Trading Plan, which is a nightly blueprint for the action he plans to take in the markets on the following day. That's kind of like a crystal ball, I'd say. So I'm going to mute myself and turn you into the presenter and the organizer, and then you can take it away. Now, it'll cut your mic out for about 3 seconds when I turn you into the organizer. So hold on a second. You are back. Welcome and thank you. Welcome and thank you.
All right, folks. So I thank you for the introduction, and I am going to try to cover, everything that we were both going to cover today. As she just said, we've got a little Yorkshire Terrier who, we just went on a ski trip to Park City, and we took him along, and he started getting sick there, and we got back, and he just got sicker and sicker. So it looks like they said he's got an infection. So Julie is off taking him to be admitted to the 24-hour animal emergency thing. So she's not going to be here. I am going to be here. I'm going to do my best to cover what she was going to cover. And part of what she was going to do, we've got set up as a thing that you can log in and do remotely. And then she will follow up with everybody next week, as to that. And I'll explain that when we get to it. So let me just get started here. I'm going to tell you that most of what we see, or most of what we've done, does err on the side of your psychology is going to get the better of you. So I'm going to talk today about strategy, and I'm also going to talk about psychology and what it takes to go and deploy a strategy and be able to do it successfully. Julie and I have been trading together, as I said earlier, since 1997. So we met in graduate school. We followed up, and we were doing this stuff with the New York Stock Exchange. We're gathering all this data about the markets and just trying to figure out what makes everything tick, and how can we go about better isolating where the volatility is coming from, identifying what the psychology is of the participants in the markets. That's Julie and me on the floor of the NYSE. We're there at least once or twice a year to this day. It's a very different place now than it was back when we started. Things are not as active down there by any stretch of the imagination, but it's still very much a place that revolves around the personalities of the people who are making the trades or who are responsible for trading a particular stock. So we've added a bunch of stuff to our repertoire over the years. We don't only trade NYSE anymore. When we started, the NYSE was the place you wanted to trade because that was the legitimate market. It was almost as if NASDAQ was a pink sheet market or something. But today with the ECNs, once ARCA took over at NYSE and the ECNs became involved at NYSE, what happened was NYSE, NASDAQ, those lines are blurred. It's still a more stable market, I think. It's still a more predictable market than some of the over-the-counter stuff, but it is much more similar today to NASDAQ than it ever was before. So we both have PhDs and MBAs. We're both doctors of psychology. That has come in very, very handy in our trading. I'm going to tell you that, the training that we do with people, we do lots and lots of live stuff, lots of education. Twice a year, we do this boot camp that's in the upper left corner there. And those are guys who are coming to have this really intense, very rich experience, learning how to trade our stuff. So most of them, I'm going to say almost all of them, have turned into profitable traders. It takes time sometimes. Most of these guys are earning their living trading now. And it takes time. And the reason it takes time is, the war room is squarely between your ears. If you go around that table there, I'm looking at these folks and I see a guy who's a cop. I see a guy who's an attorney. I see a guy who was a farmer. Some folks from up in San Francisco who ran their own business. There's a dentist there. There's a physician there. There's a fellow who sold, oddly enough, urinal cakes, who has been our client for going on 10 years or 11 years. He was at the very first boot camp. He's been to every one since. What makes these people unique and what makes their stories interesting is each one of them brings a bunch of psychological garbage to the table. So whoever you are, you're bringing your relationship with money, your relationship with risk. You're bringing your entire history with you when you try to do this thing, this trading. And whether you know it or not, your demons are definitely going to influence your ability to make a living trading stocks or trading futures or trading options or whatever it is that you trade. Because there's a very different profile between a guy who's a gambler and a guy who knows exactly what he did to earn his last buck. There's a very different profile between somebody who's very, very high in conscientiousness, right? They follow through on everything. You can always count on Bob, that kind of a thing. He's always going to do exactly what he's going to. And the counterpart who is very laissez-faire about getting things finished. And these are the things that Julie was going to talk about today, is sort of conscientiousness and risk and neuroticism. And I'm going to show you later where you can go and for free, just fill out the surveys that she was going to have you do here today. And then we'll go ahead and get back with you next week and go over the results in sort of a live forum and tell you, in a live stream, here's what all this stuff means. But, just bear in mind, again, all those guys, top left corner, managed to get profitable trading. And if they can do it, you can do it too. It's just a matter of you need to know yourself, and you need to be true to yourself, and you need to be able to work on some of the things that hold you back when you're trading. Now, I have to give you a bit of a shameless plug here. We are in summer of 2023. You'll see us on a new television program called Trader Nation. I believe it will be airing sometime midsummer is when we're going to start this. We already filmed the pilot and filmed some interesting collateral materials that go along with it. It's going to be a good show. It's going to talk about exactly this kind of stuff. We're going to go do deep dives into different traders. We're going to talk about the things that they sort of need a makeover with, how they succeed, how they fail, where the hurdles are to the whole thing. It's going to be sort of a psychological dive into what it takes to trade the markets. I encourage you to look for it. It's probably going to be on the Scripps network. It's either going to be on Scripps or it's going to be on Warner Communication Networks. But I think it's going to be a really good show, if I do say so myself. And I hope you're going to watch. But let's move on. And let's talk about, I know we already discussed sort of my background. I publish a lot of stuff. So I like to write, I like to get things out there and let people know what it is that we're doing. I like for people to follow what we're doing. I like for people to be interested in it. This goes back to, we're both PhDs. PhDs publish. You publish the things that you're working on. Nothing that we do is a black box. Nothing is a secret. Everything that we train people to do or that we talk to people about is very much out there in front of you. It's all driven by market cycles. It's all very organic. So Around the Horn, A Trader's Guide to Consistently Scoring in the Markets, that was the bestseller. That was the first book. It's out of print right now. That covers the entire philosophy. And Around the Horn was a baseball analogy, because I think the psychology of trading is very much like the psychology of baseball. Baseball players, man, they step up to the plate, and if they're thinking about the time they struck out, or they're thinking about the time that they hit a home run, and those things are in their mind, they're already done. They're finished. You have to be able to step up to the plate and take a clean shot at the ball. You have to be able to step up to the plate, take a clean shot at the markets. And all of that is reflected in Around the Horn. Around the Horn is a series of market-driven patterns. It's all about, is the market in an accumulation? Is it in a distribution? Is it in a markup phase? Is it a markdown phase? And there's these patterns that occur very, very predictably as the market moves through these different natural cycles that it goes through. So the market moves around the horn, and Around the Horn is all about following those cycles. It'll be back out later this year. I have to talk to my publisher. I'm very late, very, very, very late. Not at all conscientious about following through on my obligation to get a rewrite of that book. It'll be its fourth printing. It's been out since 2001, so it just needed a facelift. It needed a refresher. Trade Secrets, that was the follow-up book. That takes one strategy and just tries to show how one strategy from Around the Horn, expansion of range and volume setup, can be applied to different time frames, different instruments, it takes trading and tries to simplify it and say, look, if you find something that works, you can adapt it to different scenarios, different time compressions, different instruments, and you can make this stuff work across all sorts of markets. And the rest of these books, those, Tricks of the Trade is sort of a trade journal, and then the rest of those are the worldwide releases. Those are put out by Harriman House and the Italian Trading Press. So that's it. That's the background. We obviously do a bunch of education, very, very in-depth stuff. It is, at the longest point of it, it's the Income Trading Academy. That takes people and just starts them over. So we go back and we start from scratch and say, look, your psychology, your trading needs to go and just revert back to where you were when you were tabula rasa, right? You didn't have a bunch of conceptions, you didn't have a bunch of preconceived notions. You're ready to go work through this. That's a big course, right? And that winds up with the live thing in Miami Beach. We do that down in Miami Beach because here in California, we're out in Malibu, California. It's too early in the morning for most people who are coming from the east to work on a live event, right? An intense live event. All of our courses, people say it's like taking a sip of water from a fire hose. But by the time they go through them a couple times, I mean, it's 20 hours of learning in every case here. And by the time they go through these things a couple of times, they wind up with a really much tighter, much better view of the market. And everything that we do is about working with people over the course of a year. That's why these events are so small. There's only 20 people at them. And we only do 2 of them a year. So I would encourage you, no matter what it is that you're doing, to follow this kind of a psychological setup in who you're learning from and what it is that you're learning. You want to make sure that you've got ongoing mentorship with whoever it is that you're working with. There's going to be a bunch of, I don't do options. I really don't do much in the futures markets. If you're working with somebody who does options, if you're working with somebody who does futures, make sure that they'll pick up the phone. So one of my guys calls, I pick up the telephone and we talk through. We get them, right through their questions. We get them right through whatever's going on. It's important that when you pick somebody who's going to mentor you, that, you know, especially you guys who are doing options and you know, these complicated spreads and complicated derivative strategies and all that stuff, it's important somebody's going to pick up the phone, going to stay very, very involved with you and tell you immediately what you're doing right or wrong. You don't want to wait a week for a call back or wait for an email. And you want to make sure that there's lots and lots of room for you to learn, for you to practice, so that you can set up and create your own roadmap. So our goal is always get people to where they can put together a profitable trading plan on their own. So I'm going to show you today what I think goes into putting together a trading plan that works. I'm just going to do sort of one of the plans that I generally use, and then get into what's it take to trade it. So when it comes to what most people want to do, it's actually very psychologically damaging. So when you're doing this discretionary trading, when you're involved in just sort of trying to follow momentum, momentum is something that can lead you right into a trap, because generally speaking, you're buying into the swing to the upside, the swing to the downside, and you wind up sort of further away from an entry than you should be. So that means that your stop is now probably where other people's entry price was, right? And the momentum trap is you get in late, and then you wind up with bigger stops and smaller targets than you really wanted to have, or that you should have to be profitable. And, you know, while discretionary trading is exciting, right? It's especially for my gamblers, for the guys who you know, like to have something on the line, and they like to roll the dice, and they like the action and all that stuff. It seems like it's a great idea, but the reality is they wind up over trading. They wind up you know, sort of behind the eight ball constantly. And the best way to avoid this stuff is, even on discretionary trades, to pre-plan everything that you're going to do. So you're going to see in a moment here, I've got trades that you would refer to as scalps. I call them volatility bands. I don't set those up intraday. I don't sit here and watch my screens. I've got a ton of screens here, right? I've got all these planned trades up behind me. I don't sit here and watch for the momentum and try to chase it. I'm not trying to hunt for something. I'm trying to trap. I want these things to come to me, to lay into the trap, and then once they're in the zone that I've planned, I can take a trade, and I'm going to know exactly, based on what happened yesterday, what the parameters are, what the order flow looks like, what the likely outcome is going to be, where my stops are going to be, where my targets are going to be. When it's all said and done, what it avoids is the psychological damage that comes with, oh my God, why did I do that? Oh my goodness, I didn't see that coming at all. And you put yourself, when you pre-plan things, in the position of having a very, very objective framework to analyze what it is you did right, what it is you did wrong, and how you can improve in the future. So, you know, I think that this is, you know, this slide is really, it gives you the gist of it. You need a solid strategy. You need to make sure your strategies have a statistical edge. Everything that we do around the horn was originally called a multivariate analysis of covariance in the United States equities markets. It was a paper that I did. Nobody was ever going to buy that book. So we went ahead and put it into this metaphor, right? We took everything and changed it over to an analogy about baseball, because that was something people could relate to. But you want to make sure, generally speaking, you have a statistical edge. You want to make sure that your trades are going to have a positive ratio, that things are time bound. Like, I don't take anything overnight ever. Julie and I are heavily invested in Southern California real estate, all great real estate at the beaches. We've got a heavy investment in art. Those are the places that we've invested our money. We don't invest overnight. We trade the markets, and we know that for us, the time boundaries, the thing that lets us sleep at night is all the ponies come home. All the money's in the account overnight. The following day we get in. We're not doing a bunch of trades. There's maybe 10 trades in our account over the course of a session, maybe 10, maybe 15. We are not high frequency traders. We've got a bunch of setups. We wait for them to come to us. We've got very clear rules. We've got very specific entries. We've got very specific exits. And we know that everything is based on the cyclicality of the markets. So the strategy that I'm going to talk about in a moment here is very similar to just about all the strategies that I do. I'm going to go through, I'm going to isolate the volatility. We make our money in the markets by finding where there's going to be volatility. We're looking for order flow. We're looking for resting orders. We're looking for the place that the specialist or the designated market maker on the NYSE or the market makers on the NASDAQ, where is it that they've got their orders bracketed? This is a different world today. This is not the world of we're going to buy on the bid, a tick below the bid. We're going to sell on the ask, a tick above the ask, and that's how we're going to make our money. The market makers now are in there. They're actively engaged in order flow trading. They're looking for the VWAP. They're looking for where things are happening. And then we're just going to go and isolate that volatility based on what we know that they're looking for, and then trade the same way that they are. I'm not trying to beat anybody. Stock trading is not a zero-sum game. Options trading is a zero-sum game, right? But stock trading, the way that we do it is all about, we are just in the order flow. We're looking for where the order flow traders are picking up shares. Where is it that they're liquidating shares? And we're just going to go and try to get a few cents ahead of that. We're going to step in front of that order flow, and we're going to try to profit from the volatility that we're anticipating. We always determine a bias. So over the course of planning my trades, I'm looking at tomorrow and I'm saying, all right, is the bias long or short based on what happened today? We try to maintain those biases going into the session. There's time of day biases that influence our trading as well, right? There's definitely times of the day that the market tends to reverse. We're on that. We know exactly what we're looking for. There's probably 6 different reversal areas over the course of the session that we pay attention to. All of that factors into our trading. All of it is planned ahead of time. Because what I want to do is, so like I said, we're out here in Pacific Palisades, Malibu. The area that we're living in is beautiful, but it's 5:30 in the morning when we get up and head to the desk. 6:30 in the morning, I don't want to make a bunch of decisions. I just want to have a roadmap in front of me that says, here's what you're going to do. This is when you're going to do it. This is why you're going to do it. All this stuff laid out for me ahead of time so that I know exactly what's coming my way and I don't have to make a bunch of decisions on the fly. I'm not real good on the fly to begin with. So for me, looking at the charts without the benefit of time to analyze them makes it very hard for me to make sure that I'm looking at everything that's going on. So what I do is the NYSE trades that we do today, and that we've got the guys who've been through boot camp, they all trade these things too. Those are all program trades. So you're going in and you're planning your trades for tomorrow and you're entering your trades tonight. So you're using conditional orders. You're saying, look, if price is below the entry price for a long, then buy, stop, limit. The stop price is the entry trigger. The limit price is the maximum allowable slippage. And then we've got a bracket order behind it that says, if we hit the target, get us out for a profit. If we hit the stop, get us out for a stop. The NASDAQ trades, those are the ones that I'm going to go over today. I'm going to show you exactly how those work. So I'm not going to talk about those right here, but those are also programmed. So they're also set up ahead of time. And I can very much isolate that volatility and make sure I only get in when I want to get in. The opening gap reversion trades, that is a statistical trade. So that falls 2 standard deviations of volatility. We used to use the implied volatility of the front month contract for every stock on the exchange to figure out, did it gap enough to get us into the 95% confidence interval of the mean? What that means is you have a 95% probability price is going to revert back toward the average volatility in this case. Doesn't mean you're going to close a gap, doesn't mean anything else. It just means what I said. 95% of the time, you're going to make a move back towards the average volatility level. Those trades pop up on a scanner that we have in the morning, and that's a proprietary scanner that we use that just pops up and tells you, hey, it's earnings news, the stock is in the news, it's being followed, and this one has a really high probability of a reversion. So those have been that we do that in our first hour trading pit in the morning with our guys. We also go through and do some handicapping, if you will, of what's going on with the triple Qs, the spiders, the diamonds, the ES, the E-mini, S&P. And some of the guys are looking at the NASDAQ contract as well. That's a tough one, right? That's a little bit more volatile than the E-mini. E-mini S&P is probably the easier place if you're a futures trader to do the kind of stuff that I'm doing. And then we also have one that's a straight up order flow trade, also automated. I call that one fastball XRV, right? So it's an expansion of range, expansion of volume. And that one is from my hedge fund days, which weren't all that long ago. Goes through, runs a computer algorithm, looks at where the institutions were buying, where were they selling, what was the reaction to the VWAP when price moved toward it or price moved away from it. That stuff right there is very, very interesting if you are at all interested in statistics or modeling of the markets, doing algorithmic trading. But basically, what that stuff allows me to do, those different plans, is it lets me set my day up in a way that I can maximize the results that I get out of my workflow. So in the pre-market, we set up our automated trades. So I go through, I take those around the horn trades, the stocks to watch trades, the fastball XRV trades, and those all get loaded up. I'm waiting for the pre-market because what I like to do is see what the overnight futures are doing. I'm not on a suicide mission, right? If we're going to have a 600-point gap or something, then I'm going to put some of these trades on hold. At the opening bell, we go and we execute the NASDAQ opening trade. So if any of the stocks on this plan that I'm going to show you in a minute here that I put together, if any of those open around a central pivot line, or they're coming on a shallow dip into one of the levels that we have established, then we're going to execute those as opening trades. Very, very frequently, the opening trade is in Apple. So Apple is a hallmark, kind of a standard trade for us on the open. Hasn't been so much over the last couple of months with all the volatility in the markets, but generally speaking, the options market makers do a lot of cleanup on Apple right at the open. So there's pre-market support and resistance levels that you can use to easily go through and handicap where is Apple going to catch an inflection. Can I go and grab a quick 70, 80 cent per share, dollar per share profit on an opening move in Apple? So we get a lot of, we've had market makers, we've had former specialists come to the boot camps. They want to learn to be upstairs traders. That's a little bit different than sitting in front of a terminal, is a little bit different than making a market in every stock on the exchange. This one, Brian, who was a NASDAQ market maker, he was like, that's a game changer. That's a game changer right there. So that trade, right at the opening bell, it's got a very, very high probability, very high, rate of success. We love putting that trade on. After the first 5 minutes are in, right at the 5-minute mark, we start looking at those opening gaps. We're looking for those statistical setups to happen. They need 5 minutes to set up in order for the statistic to be valid. So we know that for the first 30 minutes of the day, we're going to be watching those. It starts at the 5-minute mark, it ends at the 30-minute mark. That's when a statistical distribution is going to start shifting on this particular data. So what we do at that point is we refocus our attention, look back at our automated trades, look back at the NAS trades, and then we set up to trade the triple Qs. That's my favorite. We're going to be doing a thing in Las Vegas on the 23rd, April 23rd. We're doing a big training. We're calling it Super Vol Sunday. That one is my all-day trade. So I'll sit here and watch for the NASDAQ for the NDX to come into support and resistance ranges. I look at the Qs, I look at the futures, trying to figure out where the order flow was, and I start setting it up as if I'm setting it up for tomorrow, but what I'm doing is I'm setting it up for, later in the session. I start those trades right after we looked at the opening gaps. I start bracketing up where I think the trades are going to be. I don't actually start taking those trades until 8:30 Pacific time, so until 11:30 Eastern time. So that's my workflow. So when you're putting together these discretionary trades or semi-discretionary trades, the way to make them a good pre-planned trade that is going to be easy for you to analyze, easy for you to profit from, easy for you, everything gets easy if you start with the big picture. Start with the big picture. Look at what are all, what's the sector doing? What's the stock doing? What are the indices doing? What was the market doing yesterday? Up, down, sideways, big gap, no gap. Look at the big picture, figure out exactly what your bias is for the following session. Do I think that Microsoft or Netflix or Tesla, because I do this on the super cap stocks, do I think those stocks have a very high probability of following through to the downside or following through to the upside? And if there isn't follow through on my bias, that's all right. I just skip those trades. Because what I want to do is I want to find out where the institutions were moving money. I want to follow the institutional footprints through the market. I want to figure out where there's confluence, where is there an overlap between support and resistance, between order flow, between volume on the upside, volume on the downside. I'm going to show you all this in 2 seconds here, but that's how we get in front of these very, very high probability trades. People get frustrated. I've got lots of guys who will jump on these trades. They'll jump on them right at the open. And I tell people flat out, most of the time, I don't trade the open on these particular setups. Don't be impatient. Just wait for that high probability setup to come. Wait for the market to settle in. Take your profits at the inflection levels that you've identified, and make sure you take stops where you've identified an inflection level, and then allow enough elasticity. You want to allow for the market. If the last time price hit the level that you're setting a stop, it moved through that level by 15 cents, then you need to give it that same amount of elasticity the next time that you trade it, right? You need to give it 15 cents or so beyond what you're saying is a logical stop and get yourself set up so that you can get right in front of this trade. So this is the volatility band setup, right? So it comes, what I do is I set up 3. At this point, it was Baba, Netflix, and Tesla, and then I've got Apple. I've got all the levels on Apple going into the morning. So, what are the guidelines for our strategy? So I'm going to tell you that, for me, once again, I want to find where the institutional order flow is. I definitely need to identify my bias. And to get the bias set up, I need to identify the trend. You need to be able to look at this thing objectively and not just say, I'm going to follow the momentum. I don't know anybody in 25 years of doing this. I don't know anybody who's really successfully been able to just go in and trade momentum. It's just not going to happen. The better thing to do is try to anticipate where the momentum is going to be. So where is the market going to pick up a head of steam? Where's the support and resistance? Where's the volume? Where's the order flow? How do I identify this area that I call confluence here and say, if price gets there again, I've got a very, very high probability that I'm going to be able to figure out exactly where price is going, once the inflection happens. So I set a trap. If it's a long, I'm waiting for that price to come to me. I've got either a stop limit or a limit order, right? If it's coming from above, it's going to be a limit. If it's coming from below on a long, it's going to be a stop limit. You set all these things up ahead of time and wait for the market to come to you. Most importantly, you've got to know where you're going to get in. You got to know where you're going to get out, because to a man, everybody who works with us or everybody who's worked with us was just, if it's going in my favor, then, I'm going to hop on it. I'm going to use a trailing stop. Well, what's your trailing stop? Well, I'll use 15 cents. I'll use 20 cents. And I just say, that's a guarantee that what's going to happen is it's going to hit your profit target because that's natural support and resistance you've identified. And then what's going to happen is you're going to get taken out 20 cents away from that profit target, right? You're going to $200 if you're trading 1,000 shares are going to vanish because the reason you put your target at that inflection point was in your head, that's where you saw the order flow. In your head, that's where you thought the psychology of the market was going to drive price. That's where price was going to terminate. And now all of a sudden, because you're thinking on the fly, right, you think you've got a better idea, and those better ideas rarely wind up being more profitable. So just always, be true to your plan, follow what you said you were going to do, make that the metric that you use to analyze whether or not you're a successful trader. Did I do what I said I was going to do? Worry about the money later. Worry about whether or not you're actually booking profits down the road. Worry right now about plan the trade, trade the plan. That's my metric for whether or not I'm successful. So let's talk again about discipline, right? And then we'll get into this stuff here. Again, you want to use, I just said, you want to use conditional orders. You want to bracket things up. You want to make sure that you've got a stop limit order. If you're getting never do a stop market, you always want to make sure you control the slippage, control, where price is going to take you on your way in, and only enter when price is moving in the planned direction. Don't catch a falling knife, right? All the stuff that you've heard over the years, you've heard for a reason. It's because bad things happen to people who go and try to break the discipline, break the rules. So here is how I set this plan up. So you can see when I put the volatility band trades together, what I'm doing is I focus on the most liquid stocks that made the most predictable moves yesterday. So I've actually got a stable of about 10 stocks that I follow for this thing. And recently it's been Microsoft, Netflix, and Tesla. On this particular day, which was yesterday, Microsoft and Netflix never got into the bands. So they never got into the ranges that I was looking for. Is that a bad thing? Is that a failure? No. It just means no trade. And no trade is better than a losing trade. What I did focus on was Tesla. Tesla came in. We had a first entry at 193.30 for a short, down to 192.42 as a first target. The second target was from 2.42 down to 191.75. And then 1.75 down to 191 was the third band that I had set up. So now how did I set up these bands? You're looking at a chart, 5-minute chart. This is real tick as took over real tick a couple of years ago, and as is marketing this as an execution management system for institutions, but it's a very good tool. It's expensive, but it's a very, very good tool to go through and allow you to bracket up where the volatility is and what's going on in the market. On the right side here, you see this is a volume by price algorithm that goes through and identifies where the important volume happened, right? Where was the order flow? So it's not really a histogram of volume by price the way that say your Ameritrade account is going to show it, or TradeStation or something. Those are going to show you actual prints at each volume level. This goes through and isolates where the order flow really kicked in and where the important volume was during the session. And what you see here, this is on Wednesday, is I go through and I isolate where's natural support and resistance, how does it relate to that stuff on the right side, that volume by price, and where can I identify that there are significant points. In this case, it's a downtrend of sell-off. So where are the institutions coming in and just hammering this thing? And you can see that it's a very logical progression lower. Now, I try to limit this to 3 entries, 3 targets, because it's just a lot to manage otherwise. But I've got all these other levels in my head over the course of the day. And what I do is you saw that trading plan, there they are, 3.30 down to 2.42, 2.42 down to 1.75, 1.75 down to 1. Those are the ranges that I'm anticipating could have had all this stuff, right? Would have been great if it would have been on the plan. It wasn't. It wasn't on the plan. Nothing wrong with that. We waited for the opportunity to come to us. So Julie in the first hour trading pit told the guys when it broke the blue pivot there, when it broke R1, she said, look, this is a good place to put on a short. We're considering these ranges as well. That allowed you to book $6. That's fantastic. But let's say you just waited for it to come down, test your threshold level. This is all part of the discipline. Got it back above the threshold level, did not go and exceed the prior resistance, came back down, got you in, moved through all 3 sets of those bands for a $3.30 per share profit. This is what letting the trade come to you can do for you. You're not going and trying to jump on the momentum. Bernard Baruch said best, I think. He said, successful speculation is the art of anticipating the anticipators. So what was true 100 years ago is still true today. What you're trying to do is figure out what the psychology of the market is and how you can get in front of that psychology. And if it sold off yesterday from a level, then what's the most likely thing that's going to happen today when it hits that same level? It's going to sell off again. So you're trying to get in front of that opportunity. You are just trying to step in front of the order flow and be part of the opportunity when it happens. Okay, so that's how I execute. The psychology of this is a very different thing. I see this every day. I've got a couple guys who, every day there's a conversation, every day there's a text, can we talk? And it all revolves around, it's hard to do the right thing, even though you see it play out every time. What you remember is the time you stepped up to the plate and you struck out. So you put yourself in a position of falling into all of these things right here. You failed to pull the trigger on the setup. When it came down and Tesla bounced back up through that level and it told you this is exactly where you should be getting in, you didn't get in because you remember the time that it creamed you. You remember the time that you got in and it went against you and you've got this, oh, I saw this before. I've seen this happen before. I talked to a family office client of ours yesterday, and we were talking about the triple Q setup, and we had been trading it during the Fed announcement. Fed announcement's a very predictable behavior for the indices. We know that after the Fed speaks, after the interest rate announcement was going to come out, regardless of what, quarter point, half point, no point, what we know is going to happen is the market's going to make a big 1, 2, 3, 4 swing. And I said, okay, well, we're going to get in at this level, and we're targeting this level. So it was a short sale, and we're going to these are the parameters that we're working with. This is the bracket, and I said to my family office client who trades very big tranches of stocks, and I said, well, how'd you do? I said I booked $2 on the triple Qs on that swing. And he said, I stopped out. I had my stop set at a nickel because I didn't want to get caught in the volatility. A nickel on a big position like that that's just saying, I'm going to hand you the $5,000, right? On a big trade like that. It's going to swing a nickel. It's going to swing a nickel because you've been looking at the chart all day. A regular bar has, 20 cents worth of range in it. On a 5-minute chart, what on earth makes you think that after a big announcement, there's only going to be a nickel adverse excursion before the thing goes and just takes off in your direction? It doesn't happen that way. You've gone and let the psychology get into your head. Another thing that we see often, people let losing trades run and they cut their winners short. So it's the opposite of conventional wisdom. It's the opposite of what you've been told the whole time. I'll tell you why it happens. Feels good to win, feels bad to lose. That's a basic psychology of every human being you've ever met in your life. Nobody wants to lose. Nobody wants to go and book the loss. So what we see all the time, I've got a trader, John, I'm sure Conforti's not going to mind me using him as an example. He'll get in to an Apple trade, to an Amazon trade. Those are his favorites. He trades Tesla and gets right back. When he's got 10 cents, 15 cents, he's out. But there's no stop on the other side. He'll let it swing dollars against him because he says it always comes back. And I'm not going to book the loss, but I like to book those gains. I like to book those gains. So at a boot camp, we went around and I said, well, what's going on? And he says, well, I had $1,500 of profits around the open, but 30 minutes in, I'm down $4,000. I said, 5-minute chart bars on a chart. In 6 bars, he had 300 trades. This is somebody who's looking for the action. This is somebody who's looking. You can see him, and he's one of the very first trader interviews on our upcoming show. That particular pilot was called The Gamblers. There's a couple of guys who do really well. They've got a gambling mentality. There's a couple of guys who get themselves right in front of a freight train because of their gambling mentality. But you see it, and what you see is the guys who have succeeded with that particular predisposition to gamble. They've succeeded because they managed to wrangle the thing in. They managed to get the gambling under control. They've got that gambling mentality sort of in the background. They're not letting it come to the front. They're taking calculated risks. They are much like a poker player, not at all like somebody sitting at a slot machine. We've also seen lots of people adding to losing positions because, well, it's coming down, but now I see it's coming into another support level. So what I'm going to do is I'm not going to take my stop. Instead, I'm going to double down. And then if it bounces halfway back up to the original entry price, I'll be at break even. And if I just get to break even, I'll take the trade off. And then it bounces and they don't take the trade off because then they say, well, now if I could just get it to where it's a little bit profitable, then this whole thing will have been worth it. So they took an unplanned trades. They've added to the losing position. And what it does is, at the end of the day, makes the psychology completely unmanageable. There is no way to reconcile with yourself why you've done these things. So all the rest of this, right, holding trades for a home run, that's again about not following your plan. It's going in your direction, so now you're going to hold it, and then when it goes against you, or you held it overnight or something, and in the morning you get up and it gaps down. Now you just got to be kicking yourself. And then the other thing that people do is reduce position size when they take a loss. So they'll be trading the Qs, they're trading 1,000 shares, 500 shares, 100 shares, whatever they're trading. They take 1 trade, 2 trades that go against them. It's perfectly within the statistical model, but now they're I'm going to reduce my share size, just make sure. Then that next trade goes in their favor, and then of course they ramp up. And then when they ramp up, the psychology is different. Now there's more money on the line again, and they wind up just in this cycle of losing money because they're not following always follow your discipline, always follow your trading rules, always avoid. These are the Julie things here, right, that she was going to talk about. Filtering, focusing on the negative, ignoring the positive. Oh my God, I remember when I struck out. Oh, it's catastrophizing. We've got somebody who's up 40% in his account for the year and wants to tell us repeatedly he does not know what he's doing. And I tell him constantly, if you're up 40% and this is the 3rd year that you're doing it, what you're doing is trading as well as, if not better than any hedge fund manager on the street. What makes you think that this is such a catastrophe? But look down these lists here and just think, do you see any of the characteristics of how you tend to approach life, how you tend to approach trading? Do you see any of that? And then how can you go and change your mindset? Julie has put together a very good set of psychological instruments on traderinsight.com. So if you go to traderinsight.com/challenge, this is not a subscription. This is not anything that you're buying. There's no credit cards. There's no nothing. There's tests there. There's psychological tests. One is the trader work environment scale. One is the trader type inventory. And there's 3 or 4 tests there. If you go through and you take those, they're going to go back and they're going to spit out scores. So for instance, the trader type inventory is going to tell you how well do you follow through on planned things that you do in general in your life that you're planning, how well do you follow through? Then it's going to tell you what's your relationship with risk, right? Are you a gambler? Are you a very conservative person? How is that influencing your ability to operate in the markets? And then the final dimension on there is neuroticism, right? How much do you blame yourself? How much do you play that blame game? And, how often do you go down that rabbit hole of, I did this wrong. I'm, oh my God, I'm going to screw everything up. I'm not a good trader. I'm not good at anything. I'm not good, whatever it is that self-speak does to you. All that stuff's identified on these metrics. And then what we suggest is, we give you access to all of our trading plans and all that stuff for a couple of weeks after you do this. And what we suggest is go and load them into a trading simulator. So go do something like, Trading Sim, or if you're using TradeStation, use that simulator, whatever simulator you can get your hands on. Go simulate this stuff and take a look at the results. Now, Julie's going to do her little portion of this seminar. She'll do as a recording that you guys can watch after you took those tests, and then look at your results. Can I follow through on the rules? Can I go replicate what the results were that Adrian generated and Julie generated? Can I go through and stop playing the blame game and relate that to your scores on those tests? And what most of our guys find is it's sort of an aha moment of, yeah, I'm not as in touch with where I am as I probably thought I was. So this right here is a representation of what it takes to get yourself together. Like, everything has to be inside that big circle, inside psych. And for us, how do we do it? How do we get to where, we trade consistently and, we've been doing this forever? Well, we take lots of breaks. And I do trade from the beach. You saw my office a minute ago, right? I've got a ton of monitors. I got all the equipment in the world sitting here. But we'll go down to Miami, or we'll go down to Zuma Beach here in Malibu, and just watch the program trades going off on the computer. We go up to Mammoth. We go to Park City. We ski at least 8 weeks every single winter. We're gone. We leave. We pack up our kid. He's homeschooled, or he's in a hybrid homeschool, right? He's 15 years old. He's hyper intelligent. He can log in from anywhere and get his schoolwork done. We like to go skiing. He's a great skier. I'm a great skier. He's a great skier. Julie's a great skier. We all do the double blacks and all this stuff. We like to be out there and clear our heads. You got to keep your head in the game, and the only way to keep your head in the game is to get your head out of the game sometimes. So you need downtime. You need to be able to make time for yourself, time for your family. And when you check out, just go and let your thoughts do something else. Don't think about the market 24/7. You need to be able to detach yourself from it, and you need to get yourself just sort of cleaned up and ready to come back. I'm always reinvigorated when I come back, always ready to go, always happy about what I do for a living, and always just thrilled about the day that's in front of me. I don't get up and have butterflies in the morning. I've got guys who say they get up and they vomit in the morning before they trade because they're so worked up about what the day's going to be like. That's no way to live. If you want to enjoy this business, get your psychology, get your body, get your brain, get your mind, right? All those things, get everything in sync so that everything is in balance, and you're going to find out it's going to make you a much better trader. So you can join us if you don't want to take the psychology test and you just want to join us for the morning gaps. Again, there's no credit card or anything here. This is just, you can come in and you can check in for the next 2 weeks, join us live. It's a very interesting sort of strategy that we do in the morning. If you go to that traderinsight.com/morning page, if the phone number you're putting in there should be for text messages. So what I do is a live stream every day where I go through and I give the guys sort of mid-morning, here's where I think the triple Qs are going, here's the strategy for the rest of the day in these index trades. And the reason it's a text is it's not always at exactly the same time. So they get a text message, click on the link on the text, it's going to pop up a Vimeo window, and then you'll see our live stream as we're doing the live stream. And it'll just be, here's your game plan, here's your strategy going forward. Hopefully that video will make a bunch of sense to you based on the fact that you will have read thoroughly this PDF that I'm going to send you. You'll get access to all of our trading plans and all that. I already told you that. Thousands of trading videos that we've done, but in this manual, which is, there's no advertising, no, it's just meat. So it is just, 30 or 40 pages of, here are the first hour trading strategies that we focus on in that first hour trading pit. This is how they work. This is why they work. This is the statistical advantage that they have. And, once you are familiar with this, then you can come in and you've got an informed way of looking at what it is that we're doing. Okay, so I would like to entertain questions. If anybody has questions. I guess you can pop them in the chat there.
All right, folks, you need to go ahead and ask your questions.
Ask your questions.
Sorry.
If you don't have any, I'll assume it was either too much information or it was so well presented that you're just totally comfortable with everything. You can also, if you can't think of something you want to ask now, or if you're watching this on a replay or you're watching the recording of this, I know they'll have a recording out there at some point, just email me. It's just Adrian, ADRIAN, @traderinsight.com. Or, I guess, we're telling you to put your textable phone number in. So I'll give you mine. It's 310-804-2248. If you have a question, you can also shoot me a text. So if you don't have something right now, I'm happy to answer them later. All right. Well, I don't see anything popping up here.
They must have heard everything they needed to know.
All right. Well, okay. So guys, I hope it wasn't awful not having Julie. Like I said, Julie really felt bad she wasn't here, but this is this little dog is very much a family member for us. He travels all over the world with us. And yeah. So, all right. Well.
Great presentation. Thank you. That's what we got.
All right. Excellent. Thank
Another
you
one
very
too. Thank you for being with us.
All right. Thanks for having me.
Have a great day.
You too.